Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Forex tips for beginners, stacking the odds in your favor. In this session, we will be looking at how to tilt the odds in your favor by showing you some tips that will keep you out of trouble and help you to make successful trades. The Forex market runs 24 hours a day and 5 days a week, but typically the busiest times are where you might expect a spike in volatility and larger price movements is during the first hour of the beginning of a particular regional session. So for example, at around 7:30 to 8:30 am GMT, the European and UK session starts and the FX market will usually become more active as more cash volume flows through the market. The same applies to the US session and the Asia session as led by Sydney and followed by Japan. Often trends will finish in one region and turn in direction as the new region opens. This is down to differences of opinion, economic data releases, sentiment, and profit taken as one region retires for the night. Wait until such time as the new trading session is well underway and until you can identify a potential trend. Become a master of Bollinger Bands. Bollinger Bands is a technical analysis tool that was invented by John Bollinger in 1980. It is a chart tool which calculates two standard deviations either side of the exchange rate, but he used it in many different asset classes, such as stocks and shares because of its success and the fact that it's highly regarded by the trading community. One of the key components that traders look for when trading Bollinger Bands is that 95% of trading activity will remain within the bands, as shown here on this 1-hour chart of the USD-JPY pair, where we have highlighted a few examples of what has happened when prices moved outside of the bands. Traders push the pair back inside and this often results in a price action reversal. Trend lines are typically manually drawn onto a chart to identify price action direction. Again, using the 1-hour chart of the USD-JPY pair, we have drawn in some trend lines. An area of support and resistance, which forms the basis of a trend, is often recognized when price action has reverted to either support or resistance trend lines on a minimum of 2 occasions. Here on the left side of this chart, this is clearly the case. 3 distinct trends become apparent using the technical analysis features. In this diagram, we have overlaid the Bollinger Bands with our trend lines. Again, this is the same USD-JPY pair and a 1-hour time frame. Now we can wait until a trend has been confirmed where price action has hit either the support or the resistance line on the 2 occasions. Then we can also wait for price action to breach the Bollinger Band to increase our odds of the price action being driven back into the bands. At position A, we have confirmed a downtrend, but where the price action does not breach the Bollinger Band, yet it still moves higher. At position B, we have a change in trend line, as confirmed here on the chart, but where the resistance line breach and also the breach of the Bollinger Bands cannot be considered as confirmation of a reversal until such time as price action has fallen underneath the resistance line, which it clearly does. This is the time to short the pair, and at the bottom of this move we have a breach of the Bollinger Band, where price action finds support before moving higher, which is time to cut the short position and buy the pair. In conclusion, use trend lines and Bollinger Bands together in this fashion to increase your odds of a successful winning trade. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future or if you have any questions about this particular video. Have a great day.